Hey everyone, let's talk about investments and continue our discussion of asset pricing with a couple more theoretically grounded models. This discussion following Bodekine and Marcus, chapters 9 and 10, will focus on two of the biggest models in asset pricing, the capital asset pricing model, the CAPM, and the arbitrage pricing model, the APT. We're going to talk about what these models actually are, how one would prove the capital asset pricing model, both in an equilibrium context as well as using an arbitrage argument, following sort of the broader, more general arbitrage pricing model. And we'll end with a few discussions of extensions to the CAPM as sort of multi-factor versions of that single factor market portfolio model. So let's begin with just talking about the CAPM. Now, this was an idea that was most popularly credited to William Sharpe, but actually was also developed by John Lintner and Jack Traynor and Jan Mawson, all in the 1960s, and interestingly, all of them independently. And all of this, of course, was built on the earlier framework by Harry Markowitz. And in the end, in the 1990s, William Sharpe, along with Harry Markowitz and Merton Miller, shared the Nobel Prize in Economics for their contributions to asset pricing in the case of Sharpe, sort of portfolio theory in the case of Markowitz, and mostly unrelated but tremendously influential as well, Merton Miller for his work in sort of the capital structure in variance theory from corporate finance. So what types of asset pricing models are there generally, and where does the CAPM sort of as this theoretical consequence of portfolio theory fall in? Well, maybe the easiest way to sort of draw a dichotomy is simply along the type of argument that's used to construct the model. The two big categories are equilibrium-based asset pricing models, in other words, ones that sort of try to theoretically show what investors would hold in an equilibrium given certain preferences for risk and return. And the other big category is arbitrage-based models. Primarily, of course, the APT and certain special subcases of multi-factor models that are motivated by arbitrage pricing arguments. Essentially, the idea being that if you can sort of represent payoffs using factors, then you can essentially say that the factor loadings and expected returns must follow a defined relationship simply by no arbitrage arguments. And indeed, actually, quite a few asset pricing models can be interpreted as straddling both perspectives. In other words, they can be explained both as an equilibrium model and as a no arbitrage, arbitrage pricing type of model. A good example of this would be the Fama-French three-factor model that takes the CAPM and adds to it a couple other factors such as size and value. And from the sort of equilibrium side, researchers have tried to figure out what actual risks that might be priced in equilibrium are represented by the size and the value factors. And of course, from the arbitrage pricing side, it's mostly sufficient just to show that these do actually span the cross-section of returns, and therefore they should be priced, and their exposures should be priced, or the exposures of all assets to these factors should be priced consistently with each other to avoid arbitrage. And indeed, we'll actually talk about the CAPM in both of these perspectives. We'll talk about the CAPM as a equilibrium model, simply deriving from investor preferences, and we'll talk about it as a no arbitrage argument, talking about sort of priced factor exposures and how deviations from pricing according to the CAPM could be arbitrage trades that would then revert prices back to sort of a CAPM type of equilibrium. And indeed, sort of the equilibrium models are linked to no arbitrage models in a fundamental way, simply because arbitrage is sort of how equilibrium gets restored. And of course, the idea here is that anybody who's sort of an active manager in finance is on the lookout for mispricing opportunities, and as sort of a subset of active management, arbitrageurs specifically focus on creating trades around mispricing. And this activity will actually push prices back toward what their equilibrium levels actually should be. So it isn't to say that these two paradigms are completely orthogonal to each other. The equilibrium asset pricing models and the arbitrage-based asset pricing models are related in this idea that arbitrage activity pushes prices toward what they should be in equilibrium. So what is the CAPM? Well, let's begin by sort of talking about what assumptions about investor behavior actually drive it. It's being sort of a theoretical derivation based on portfolio theory. It, just as portfolio theory does, makes certain assumptions about individual investors and then uses them to prove this sort of linear relation between expected returns and factor exposures to the market portfolio that we saw in a more informal setting in our discussion of the single index model. So to prove that sort of single index model relation more theoretically, we assume several things. First of all, that each investor is small relative to the market. In other words, they can't individually influence stock prices and must sort of take them as they are. Now, is this assumption reasonable? As with any model, one should sort of keep track of what the assumptions are and use them as sort of caveats. Not necessarily to say the model is not good, even if the assumptions aren't ideal, but more to show where some of the deviations from reality might actually lie, and therefore where some limitations of the model might actually be. So are investors actually small, and must they take prices as given? Well, if you think about Warren Buffett or other famous investors, the news of whose position increases or reductions actually does move market prices. Or if you think about activist funds whose investment strategy is actually based on disclosing their positions and the reasons for taking them in a hope to move market prices, one can see that this, of course, isn't necessarily the way things always are. But on the other hand, if one thinks of a mutual fund manager or even an individual retail investor, that's certainly how things are. Now, similar to portfolio theory, we also assume that each investor has the ability to borrow and lend at the risk-free rate. Now, we talked about the limitations of that in our discussion of portfolio theory, and it's good to revisit them here. Remember, it's unlikely that everybody can borrow at the risk-free rate, even if they can lend to, let's say, a very safe government by buying its treasury securities. Well, they probably can't issue those treasury securities. So there might be a kink in the CAL, simply because the borrowing rate is going to be different from the risk-free lending rate. So again, not necessarily a 100% realistic assumption, but one that does apply to certainly some large institutional investors. The third one, that investors pay no taxes and have no transaction costs, well, that of course is certainly not true, no matter the size of the investor or their other characteristics. Everybody faces taxes and some transaction costs. Similarly, from portfolio theory, we assume that each investor is a mean variance optimizer. In other words, all investors are risk averse. They like expected returns, the more the better, and they dislike portfolio variance, the less the better. And therefore everybody constructs an efficient frontier and holds some combination of the risk-free asset and the tangency portfolio. In other words, everybody sort of behaves in a way consistent with portfolio theory, which shouldn't surprise us, because remember, the CAPM is sort of a extension or a consequence of portfolio theory. But does portfolio theory actually get followed in the real world? Should we assume that all investors are mean variance optimizers? Well, we certainly know that retail investors are often under-diversified. And indeed, not everybody actually constructs mean variance optimal portfolios, even among sophisticated institutional investors, potentially by design. Again, think of these activist investors who actually choose to hold focused positions in a small number of firms in which they might have an information advantage, rather than holding a broad, diversified portfolio. So again, an assumption with some limitations, which are important to keep in mind. Next, each investor will construct the same efficient frontier. So not only is everybody a mean variance optimizer that will hold a diversified portfolio that falls on the efficient frontier, but indeed it'll be the same efficient frontier. In other words, everybody has the same forward-looking estimates of the mean, variance, and covariance of assets that we would use to construct the optimal portfolio following portfolio theory. This, of course, is highly improbable, just given the amount of volatility we observe in the markets and the number of different bets that go on, and even the fact that there are actually people willing to buy when other people are willing to sell, shows that people hold different beliefs. Not everybody really has the same forward-looking estimates of any of these payoff characteristics of risk assets. So this is a highly improbable assumption. But you might think about sort of a representative agent that has sort of the preferences that most closely match the average in the market. So also not completely indefensible either. Furthermore, all investors have the same investment horizon. Now, this of course wouldn't be true either, because we know that among retail investors, younger investors have a longer horizon, older investors have shorter horizons, and among institutions as well, there's, for example, high-frequency traders that will hold a position for less than a second, perhaps. There's long-term informationally advantaged investors, such as Warren Buffett, for example, that will hold positions for decades, and everything in between. So investment horizons do differ, and therefore this assumption is not very realistic either. None of them really are. But they simplify the analysis to the point where we can actually derive a useful result. So just as with other models that rest on assumptions, the common saying goes that all models are wrong, but some models are useful. In other words, a departure from reality in assumptions can be justified if we can actually learn something that seems useful from it. And indeed, the CAPM can tell us a lot of useful things, even if the assumptions it rests on and its sort of full accuracy is still in doubt to this day, since when it was first put forward in the 1960s. So what does CAPM essentially tell us? What did we get in exchange for making these sometimes unrealistic assumptions about investor behavior? Well, the main insight from the CAPM is that all investments must have the same risk-reward ratio. Now remember, we sort of conjectured this using the single index approach, but that one's more of a descriptive idea. We just saw that generally it seemed like stocks move all together with macroeconomic risk factors, especially something like the market portfolio. Well, the CAPM actually formally proves that this is the case, and that's sort of the value of it. It goes from being a descriptive model to actually explaining why things are this way. And specifically what it shows is that the risk premium, as measured by the spread between the expected return on any asset and the risk-free rate, is proportionally related to the amount of risk that this asset or any asset takes, measured by the systematic risk of a security or a portfolio in terms of its exposure to the market portfolio. And the other powerful insight that, again, we sort of informally saw with the single index model, but now can formally prove with the CAPM, is that then, of course, no investor will take on idiosyncratic risk, because if all expected returns are driven by exposures to systematic risk, and therefore there is no compensation for holding idiosyncratic risk, well, then any investor who is a mean variance optimizer and is therefore risk averse won't want to hold any risk that is not compensated, and therefore will not take on idiosyncratic risk. And therefore, sort of consistent with portfolio theory, consistent with the single index model, everybody is essentially going to hold some combination of the risk-free asset and the market portfolio. They'll fall sort of on that capital market line connecting the two, and therefore everybody's really going to hold the same well-diversified portfolio, the market portfolio, just in some proportion with the risk-free asset, as we already saw in portfolio theory. So in other words, only systematic risk gets priced. So how do we measure systematic risk in the CAPM? Well, again, sort of building on our informal intuition from the single index model, we know it should be your exposure to the macro risk factor. And of course, if in the CAPM the macro risk factor is the market portfolio, then it should be the asset's beta on the market portfolio. How do we estimate an asset's exposure to the market portfolio? Well, we calculate the security characteristic line, in other words, the slope of the SCL, and that'll tell us sort of how proportionally the returns on any individual risk asset correspond with returns to the market portfolio. The beta of the market portfolio is, of course, going to be equal to 1 because, sort of as a tautology, if the market goes up by 10%, well, the market goes up by 10%. So that means that the proportional change in the market portfolio is going to be perfectly related to itself, and it'll move directly proportionally to itself. Now, on the other hand, any risk asset whose beta is greater than 1, in other words, let's say a risky firm with a beta of 3, if the market increases by 10%, then in other words, the excess return to the market is 10%, well, for a beta of 3 asset, the excess return should be thrice that, or about 30%. And if the market falls by 10%, the risky asset that has a beta of 3 would fall by 30%. So in other words, an asset with a beta of more than 1 is riskier than the market, and an asset with a beta of less than 1 is less risky than the market. So for example, if an asset had a beta of 1/2, well then, if the market rose by 10%, this asset would only rise by, let's say, 5%. What are some examples? Well, generally, riskier firms like firms in the tech sector have high betas. Firms that are considered less risky, such as utility firms or consumer staples, have lower betas. And indeed, if you sort of look at enough security characteristic lines, you will see that some have more steep slopes and some less steep ones. And there's sort of common characteristics across industry clusters, where all firms in a certain industry will have higher betas and all firms in a certain industry will have lower betas, sort of consistent with that adjustment factor that we saw in the single index model discussion. So as we saw in the single index model discussion prior, essentially the beta, now sort of more formally conceptualized and proven using the CAPM, actually just captures the risk of any security relative to the single risk factor, the market portfolio. And indeed, the CAPM is essentially just a special case of the single index model. Essentially, we're saying that the total price change in a risk asset, such as a stock, is going to depend on two large things. First of all, the movement in the macro risk factor, which is to say the market, in the case of the CAPM. And even though there could be many separate sources of risk, they sort of all get reflected in the market as sort of this aggregate macroeconomic risk factor. And everything else is going to be specific to the stock itself. That's sort of the firm-specific shocks like scandals, acquisitions, turnover in the C-suite. That's the stuff that will cancel each other out. Some of it will be good, some of it will be bad, and in a well-diversified portfolio, it should come out a wash. So the CAPM is essentially just a special case of the single index model. It's just a much more rigorously proven case. So how do we actually go about creating the CAPM equation and furthermore proving that that's really the way that expected returns should relate to asset risk? Well, the intuition for the CAPM is very much similar to the intuitive argument for why the single index model should obtain. In other words, an argument based on the reward to risk ratio. When we talked about the index model, we made sort of an allusion to the idea that the reward to risk ratio should be the same for all assets. In other words, the expected return should be proportional to the covariance between the asset and the macro risk factor. Now, if we think about the CAPM in specific, where the CAPM's measure of co-movement with the risk factor of the market portfolio is the beta, we can essentially construct a similar risk-reward ratio, different from the Sharpe ratio. Remember, the Sharpe ratio uses volatility as the denominator. But here we're going to use the excess return over beta as our risk-reward ratio, and we're going to again say that this ratio has to be the same for all risk assets because they all fall on that capital market line. And with that, of course, if we take this equation and we simply rewrite it, we can make a simple simplification here, saying that, remember, what is the beta of the market portfolio? Well, the beta of the market portfolio is 1. So instead of beta m, we can simply write 1. And then this equation can be simplified to the CAPM relation pretty much directly. The only thing we need to do is just move the risk-free rate that was giving us the risk premium, or the excess return, on our risk asset over to the right-hand side. And there we have the CAPM equation. So this shouldn't be viewed as a formal proof, of course. This is simply the intuition for why the CAPM is expected to hold, based on the intuition from the single index model that risk and return are proportional to each other. But I strongly encourage you to memorize this relation, mostly because it'll sort of help you build understanding for how risk and return works. In other words, this idea that risk should be proportional to return. And when we say return, we're talking about excess returns above the risk-free rate in both cases. And when we're talking about risk, we're talking about a factor exposure. All of these sorts of important conceptual details are represented in this relatively simple equation. And that's why I think it's worth memorizing.